Hello and welcome to the Mutual Fund Show. I'm Neeraj Chow. The next 20 minutes, we'll talk about, a burning question in the minds of a lot of people, which is that with the interest rates being so high and banks talking about such a high fixed deposit rate, should people take in the risk-free bank FD as opposed to bothering about any kind of mutual fund to invest into because those returns are strong as well? I'm sure this thought has caught the mind of a lot of people. Well, we thought we'll get in Vijay Mantri, who loves playing around with data to try and tell us whether people should indeed bother with debt mutual funds or people should simply look at bank FDs, which are straightforward and simple. Not that debt MFs aren't, but this is in perception even more simple. Vijay, great having you. Thanks for joining in. Hope all is well.
Thank you very much.
So, should people look at mutual funds at all? FD may the returns are pretty good.
Yeah, I think people should examine because what happened that whenever people compare debt investing, they look at current FD rate and then compare the last 1, 2, or 3 year return of debt mutual fund. In the rising interest rate scenario, last 1, 2, 3 years return of debt mutual fund will not look good, but the current FD rate would look good. So investor will make a mistake saying that last couple of years return has not been good in debt mutual fund. Current FD rate is very good. So let me go and put that money into bank FD. That perhaps is not the right way to look at it because what is the current FD rate is the return you are going to get in future. Similarly, what you should be looking at, what was the FD rate 1 year, 2 year, and 3 years back, and how the debt mutual fund has done. Even if you look at last couple of years, debt mutual fund remain extremely competitive. So what is the right thing to do? To look is very simple. What is the time horizon for which you're looking at investing? 1 year, 3 years, 5 year, whatever time period you look at the bank FD rate or corporate FD rate available in the market right now and look at the comparison of similar maturity debt fund. So for instance, 7 to 45 days or 90 days bank FD is around 4%. The competitive product is liquid fund where YTM is 7.2%. What does it mean? Suppose you invest today for next 30 to 45 days in bank FD, you're going to get perhaps close to 4%. But in liquid fund, you're going to get 7% plus kind of investment performance. Similarly, you could look at 6 month, 9 month, 12 month period where the bank FD rate is maybe 4.5%, maybe 5%, and look at ultra short-term bond fund or money market fund where YTM is 7.5%. It means that over the next 6, 9 to 12 months, that is the kind of investment performance you're going to get. And you could look at 1 year, 2 year, 3 years, where the bank FD rate could be anything between 6 to 7%, or corporate FD rate, which could be 7.5%. But look at the competitive product available in the market. Low duration for 1 year product, where YTM floater and low duration YTM is 775 to 780. If you look at credit fund, if you look at medium term fund, if you look at the corporate bond fund, YTMs vary from 8% to 8.6%. So that is the kind of return you're going to get in future. So when investing in debt mutual fund, there's no point looking at last 1, 2, 3 years return because that is not what you're going to get in future. What you're going to get in future is what is the YTM of a debt mutual fund. And currently, debt mutual fund YTMs are far superior because just keep one thing in mind. In the bank FD, bank decide the rate of interest. In the debt mutual fund market, decide rate of interest. So for instance, if you look at a bank 1 year FD, it could be 5.5% to 6.5%. But same bank corporate deposit, certificate of deposit CD is available at 775% in the market because that is a market link instrument. So in debt mutual fund, if you put money in 1 year FD, you're going to get 6 to 6.5%. But if you put money in a debt mutual fund which invests in bank CD, you're going to get 7.5 to 775 basis point. That one need to keep in mind.
Okay. So thank you for that. So net Vijay, comparatively, apples to apples, if you take the right tenor, then and the right kind of debt product, then there is a marginally superior rate as well. And I presume the benefits of indexation come in as the tenure of your holding moves up slightly as well.
That's very true because the way debt is being taxed is very, very different. Debt mutual funds are being taxed very, very differently. For instance, right now, just focus on the top line. That is the without considering taxation, debt mutual funds are far superior because suppose your bank FD where interest come every 3 months or 6 months, or your corporate FD or your corporate NCD, if you don't have if you're not compounded, then what happens? The interest get completely vested. In debt mutual fund, there's no leakages of interest being not reinvested. It get reinvested very, very efficiently. Even you compound in debt mutual fund, or sorry, in bank FD or corporate FD, there's a TDS, there's annual tax outgo. So to that extent, your compounding doesn't happen that effectively. In debt mutual fund, till you take money out, first of all, there's a no taxation at all. So there's no annual tax provision you need to make. That is the one thing one need to keep in mind. Second, suppose your holding period is more than 3 months, then the way debt mutual fund get taxed is that your cost is increased by 75% of the inflation number.
Suppose 3 years.
Yes, so in a 3-year plus, suppose let's take for very simplistic reason, in next 3-year inflation happened to be 6%. So we are not compounding, we are taking a simple number. So 6 plus 6 plus 6, 18%. Now, CI cost inflation index is 75% of CPI inflation. So 6% ka 75% is 4.5%. So 4.5% plus 4.5% plus 4.5%. So it's become 113.5. I'm not taking compounding, I'm just making a simple. So if in a debt mutual fund, your 1 lakh at the end of 3 years become 1,21,000, then 1,13,500 is your cost. And the gap is only treated as a capital gain. On that, you pay 20% tax. So effectively, your tax rate, incidentally, in debt mutual fund, the average taxation rate of a last 20-year data suggests that it has been lower than equity mutual fund. So it is a far, far more tax efficient way to look at investing. And Neeraj, one need to keep two things also in mind. We pay 10%, 20, 30, 37, 39% tax. We don't have a choice as long as we are earning. Beside that, we pay 20% indirect tax on all the consumption item we have. Now we keep complaining about higher tax rate, we keep complaining about higher GST on the consumption item. But as far as investment concerned, there is a choice given by the government. I don't know why we are not utilizing it effectively.
Sure. So viewers, remember what Vijay was trying to say is that your cost remains the same, but for the purpose of taxation, the cost moves up. So for a calculation purpose, the example that he gave of 100 moving to 113 and a half, that will be the deemed cost. Your actual cost is of course 100. Your deemed cost is 113, and therefore the tax that you have to pay is only in the difference of 121 minus 113.5, as opposed to the normal instrument wherein the entire gain of whatever 18, 19, 20, 21, they'll have to pay tax on that. But I think what Vijay Mantri's done and his team have done very effectively is give us some more math around corporate FDs versus debt MFs with an example of a tenure of 60 months. So let's say that you have the wherewithal, viewers, to invest for 60 months, which is 5 years. Now, Vijay, here's where I loved the way you've explained this, and I would love you to take some time and tell us at different tax slabs the corporate FD versus debt mutual funds, the returns that come in, and then of course the kind of returns needed to match the corporate FD, and of course the category for the same.
So it's very, very interesting. Suppose you have a 7.5% corporate FD, and you bought that FD, and you bought this FD with compounding. So 1 lakh rupees invested, and suppose you are not paying any tax, 1 lakh become 1,43,000 at the end of 5 in corporate FD. To match that, a debt mutual fund need to compound your money at 7.5%. Today we have many product, medium term, corporate bond, PSU bond, where YTM has been from 7.70 to 863%. By the way, in all three category, in last 10 years, where the FD rate has been very low, in all these category, the return has been 7 for last 10 years, where the FD rate has been very, very low. So even in the last 10 years, they have done very well. Now we're talking about elevated rate of interest. So going forward, I don't see why all these debt fund will not able to beat 7.5%. Suppose we take 0% taxation. But suppose you're in 10% tax bracket, then at the end of 5 years, your 1 lakh become 1 lakh 38,000, 1 lakh 39,000. Debt mutual fund after paying tax will become 1 lakh 39,000. Effectively, debt mutual fund need to deliver 7.4% effective to match the 7.5% corporate FD rate. And that is low duration and medium term fund can do very, very easily. Suppose you're on 20-year tax bracket, then 1 lakh become 1 lakh 34,000 rupees and mutual fund has 1 lakh 39,000. To match corporate FD rate, a debt mutual fund need to compound only at 6.48%, where you have ultra short-term money market, YTM close to 7.5, 775. If you're on 30% tax bracket, then 1 lakh actually become 1 lakh 29,000 rupees at the end of 5 years. In a debt mutual fund, for the same tax bracket person, 1 lakh become 1 lakh 39,000. Effective yield on corporate FD is 5.56%. Effective yield on a debt mutual fund is 7.4%. Even liquid fund will outperform because current YTM of liquid fund is 7.2%. And suppose you're in 37% tax bracket, then 1 lakh actually at the end of 5 years become 1 lakh 26,000 rupees. In debt mutual fund is 1 lakh 39,000 rupees. Effective yield, if you're in 37% tax bracket, then on 7.5% bank FD's effective yield is below 5%, which actually call money can easily outperform. Current call money rate is 6.2%. But if you look at last 10-year data of call money funds, on average, they deliver 6% compounded return for a 10-year period. So though corporate FD give you some comfort, bank FD give you some comfort of predictability of the investment performance, real data clearly shows the debt mutual fund outperforms corporate FD and bank FD by huge margin. And one need to keep it very simple. If the banks are offering higher interest rate on FD, if the corporates are offering higher interest rate on FD, it means that they're also offering higher interest rate on the publicly traded instrument. So whether corporate issued CP, corporate issues NCD, or bank issue NCDs, bank issue CDs. So those products are being captured by mutual fund, and mutual market rate move faster either way. So what does bank do when interest rates are rising? They do not increase their deposit rates immediately. They do with a time lag, and they don't do full quantity. But the loan rate get repriced very, very fast. But in debt mutual fund, it captures the market rates. So what happens if the interest rate goes up in the economy, the debt mutual fund get repriced very, very efficiently. So I have looked at data for last 20, 25 years. I have no doubt in my mind that except what we have seen in 2018 and 20, there was a little hiccup on debt mutual fund. But debt mutual fund has added significant value to the investor with or without taxation.
Got it. Now, viewers, as a layman, I would tell you the second table that has been given, which speaks about the debt MF returns to match the corporate FD. Again, what this means to probably say, and Vijay, please correct me if I'm wrong, is that the debt mutual fund, in order to meet the returns of a corporate FD, if you are at a 30% tax bracket, for example, needs to deliver only 5.56%. And therefore, even a liquid fund will do the trick. But if you choose an ultra or an LD or an MT, which gives slightly better returns, then obviously the gains will be even further. So I think that's the point that you got to read it at. It is not that therefore you need to invest into this product. It is saying that you have a choice of investing into this product as well, which is relatively safer, and any of the others which might give you higher returns as well, in order to meet or beat the corporate FD return. So this will be explained beautifully in the story that we will write, of course, viewers. So keep that in mind. But this is just to try and explain the point that Vijay Mantri was trying to make. Vijay, thank you for giving us this data.
And one additional point, Neeraj, here, which is very, very important, loss harvesting. Suppose you had a FD of DHFL and you also had a FD of HDFC Limited. And on DHFL FD, you are not recovering money, you are not recovering your money fully, so you have some losses. But these losses will not be allowed to adjust it against the gain you are making from HDFC Limited FD. So the interest which you are gaining from HDFC Limited FD, that interest will be taxed. So you can't adjust the losses you made on DHFL FD or PMC Bank's FD or any private lending you do. But in debt mutual fund, suppose one fund has some losses, you can adjust that against another fund. There's a one part. Second part, which is very, very important, if you have a gain on debt mutual fund, be it short term or be it long term, it can be adjusted against your short term losses or long term losses in any of the portfolio, be it direct stock, be it equity mutual fund, or your real estate or gold or art, whatever you have. So loss harvesting is a very, very powerful tool, which most investors, they haven't experimented with debt mutual fund, so they are not examining it, but it's a very, very powerful tool.
Got it. Okay. Thanks for explaining that. Hopefully, viewers, you don't incur losses at all. Or if you do, then at least there is this option.
Now, and actually, Neeraj, you don't need to incur losses. Suppose you have book losses, you have a
book,
only on books,
purpose.
you can adjust. Yes, so your cost goes down.
Yes. Well, and viewers, that is what loss harvesting is about. It's an official, legitimate way to manage your taxation. I would urge you to read more about it. It's a personal finance thing. So let's not get into that on the mutual fund show, but it's a legitimate way to try and reduce your tax outgo, fully allowed by the government and the tax authorities. No penalties on the same. Keep that in mind. Okay. Now, Vijay, there is this table that you've given, which I would love for you to explain to us, because it can get a bit confusing. We, of course, prepared it as is, but it speaks about the average effective debt mutual fund taxation with some holding periods given and some returns being given on debt mutual funds. I believe this takes into account the past history of 3, 5, 7, and 10-year periods and what your taxation would have been. But please explain it to us.
So this table is very simple. I looked at actual data of last 20 years. So if your average holding period has been 3 year, or average holding period has been 5 year or 7 year or 10 year, and suppose debt mutual fund deliver you 7% return or 8% or 9% return, then what is the effective tax rate you have incurred? So let's put it this way. If your average holding period has been 3 years and debt mutual fund deliver you 7% return, then your rate of tax has been below 3%. If debt mutual fund deliver 8% return, then your rate of tax has been 5%. And if your debt mutual fund deliver 9% return, then your rate of tax has been below 7%, and so on and so forth. And if you invested, for instance, your average holding period has been 10 year, and you got 7% return, then effective tax rate has been 0.17%, effectively 7% tax free. And suppose you're lucky to get 9% return compounded over a 10-year period, it means your effective tax rate has been just 6%. Why it happens, we explained in the past, because inflation goes up. If inflation goes up, CI numbers comes higher. CI numbers are 75% of inflation, and your cost of acquisition goes up to the extent of CI number compounded every year. It is a cost for the income tax purposes. So it is not the actual cost you are paying. So you may have gain, actually you gained, but for tax purposes, the gain come down because of CI number. And also the gain doesn't get taxed at 30%, 37%, it get taxed at 20%. So because of CI inflation and 20% taxation, your effective tax rate in last 20 years in India on a debt mutual fund on an average has been much, much lower, even lower than equity mutual fund.
Now, viewers, remember, history may not repeat, but it certainly rhymes. And if you had invested in a debt MF as opposed to a fixed deposit 10 years ago, and if you had gotten just 7% return, then the effective taxes that you would have paid, or tax rate, would have been 0.17%. Now go ahead and beat that. That's the point I think that we are trying to do out this. Now, please remember, I would urge you to consult your financial advisor before taking any decision here. Maybe from your personality perspective or from the behavioral traits that you have, maybe a fixed deposit might be better suited for you, and your financial advisor will be the best person to give you that advice. But net, if you do not have a financial advisor, and if you're confused by seeing a barrage of data from banks and from everybody else about how fixed deposits are giving you such great returns, then this show is for you, because it'll give you an insight into what debt mutual funds do for you vis-a-vis what fixed deposits could do for you. So please keep that in mind. Vijay, any last words of advice? And then, of course, I want to have one final question for people who have home loans as well. But before that, any last words of advice on this topic?
So this is very important that from where the debt market return come. Debt market deliver you return which are closer to inflation. So if your inflation is 6%, debt market will deliver you 5.5% to 6.5% through various instruments. But one important thing one investor need to keep in mind that inflation compound, and most debt instrument except debt mutual fund effectively do not compound. One part. Second part, higher coupon rate does not mean compounding at the same rate of return. People have 10% tax-free bond, doesn't mean that they compounded their portfolio by 10%. Let's keep that in mind. And third point about the average rate taxation, if the returns are closer to inflation, CI cost is also closer to inflation. This is what history has done. In future also, until governments tweak their policy, the normal taxation would remain around what we have discussed right now.
Point well taken. Vijay, my final question, and that is for people who have home loans, because a lot of people do. Now, the point is, an ideal portfolio allocation advice that is given for no fault of anybody, but when it is dispensed saying that you should have some portion in equity, some portion in debt, maybe some portion or kept money for emergency or what have you. Now, the point is all forms of advice will come in with this argument that, you should diversify and you should have debt products as well. My question to you is, for somebody who's got a large home loan and is paying that above 8% rate of interest currently, or whatever, 6.5%, 7% since the last few months or quarters, do debt mutual funds or fixed deposits or any debt product make sense?
I don't think, because on FD you may get 8%, even if you get 7.5%, you need to pay tax on that. So effective rate come down to 5% or 5.5%. Even you don't pay taxes, less 7.5%. But on home loan, you're paying 8% plus interest. So reduce that outgo, because that outgo is after paying taxes. So it is just not that you are not, so you earn and then you pay taxes and then you serve housing loan. Don't fall in that trap. Suppose if you're housing loan, then whatever money you collect, please go and pay housing loan. If you're emergency, you have equity mutual fund portfolio, you can take loan against that any point of time. If you're emergency, you can take personal loan as well. You don't know when the emergency will come, but housing loan, the meter runs fixed. So just if you have a housing loan and also liquid fund, I don't think is a great combination. I think we should repay your housing loan to the extent of your debt mutual fund portfolio or FD. Have equity, which will give you much better return. And as we did a program earlier, if your equity mutual fund portfolio delivering 12% plus return, then whatever in excess of 12%, redeem that and pay your housing loan.
Yeah, well, and you need to see that show, by the way, in order to figure out how to optimize mutual funds to even work on your housing loan in a better fashion. But here's a proponent of debt mutual funds saying that if you have a home loan, then don't go for debt mutual funds. I mean, that is the reason why I think this show was so important and the last question was so important. Please, viewers, if you have such a large portion or a personal loan, which is even higher than a housing loan, then don't go about doing an investment in a debt fund, no matter how attractive the conversation sounds, even on my shows. It might be a bad idea to do that. Go and repay your loan first. Vijay, it's such a pleasure talking to you. Thank you so much for taking the time out and being with us on the Mutual Fund Show today.
Thank you.
And viewers, thanks for tuning into this live.